Hi there, you're watching Dukascopy TV. I'm Ben Jones. The EU recently announced that Greece has beat its budget targets for 2013, and with inflation data being released today, Danae Kyriakopoulou from the Centre for Economics and Business Research joins me on the line. So Danae, the inflation rate has stayed at minus 1.3%. There were forecasts for it to go down further, but it continues to show no improvement. Is this figure what you expected?
This was close enough to what we expected, and it is clear that it will take a long time before prices start to rise again in Greece. But I don't think that the deflation rate is something that the finance ministry is very anxious of. It is a largely unavoidable byproduct of the Troika program, as wages and pensions have been reduced in order to improve competitiveness. So deflation is more of a sign that the economy has transformed with major structural reforms and is now very competitive, particularly the opening of closed markets and in terms of labor costs. Insofar as such reforms continue and taxes continue to reduce net incomes, then we expect deflation to continue. But there have also been efforts to reverse the trend. For example, today the government paid the so-called social dividend to help low-income employees and the unemployed. And they have also said that they will reduce certain taxes and social security contribution, which will increase disposable income. But I think these changes will take a long time to feed through to appetite for consumption, aggregate demand, and eventually prices. And so we expect Greece to remain in deflation for now.
Now, industrial production has also been released, unexpectedly dropping to minus 3.1%. To what extent does this figure and the inflation rate have to improve to help support the Greek economy?
I think it would be great to be in a position where prices and production are actually positively growing, but this is not a necessary condition for Greece's return to growth, at least in the first instance. Those who forecast a return to growth this year expect this to be based on inward foreign direct investment and exports, and growth not to be domestically driven. So we are watching the export figures much more closely. The European Commission, for example, expects Greek exports to grow by 4.6% over 2014 as a whole. However, according to the latest data from March, export growth was only 1.4%, and excluding oil products, this figure goes down to 5.9%. So it's true that we were always going to get a weak first quarter, maybe even 2 weak first quarters, given the politically uncertain climate in Greece, which is expected to last up to the European elections later this month. And I think once the elections are over and we have a result, then business and consumer confidence will go up. And this will lead to an improvement in the weak figures of inflation and industrial production that we saw today.
And finally, it's been confirmed recently that Greece beat its budget targets for 2013, outlining the start of a potential turnaround. What can we take from this, and do you feel Greece will start to show signs of recovery?
We have started to witness a turnaround indeed towards the end of 2013, when Greece recorded a primary surplus and also had a very positive performance in exports and tourism. In fact, Greek fundamentals appeared strong enough to justify a market return earlier this year. And now Greece is back into the markets, the sovereign, the banks, and even the corporates, with Hellenic Petroleum now issuing a 2-year bond. But there are still concerns. The unemployment rate remains painfully high, especially among the youth, and it will take a long time before the structural reforms and even the fruits of an export-led growth are translated into higher living standards in Greece. Now, about Greece's return to growth, this follows straight from what I was saying earlier. Q1 data have been weak, and I expect Q2 data to not be very strong either. But whether we see a return to growth will depend on how strongly the economy performs in the second half of the year. So strong receipts from tourism in the summer, the growing likelihood of further monetary loosening from the ECB, and a general pickup in the global economy, which is good for Greek shipping, should all brighten the economic outlook for the coming months. We will also closely be watching discussions about debt restructuring after the summer, and we do not see Greece seeking a third bailout from the Troika. I think the 11 billion reserve of the Hellenic Financial Stability Fund is more likely to be used to fill the funding gap in the future or reduce the public debt. And a haircut is also probably off the cards now, while Greece is trying to regain access to the markets. So given all this, we expect growth to be modest, if at all achieved. Our latest forecast see Greece grow by 0.1% this year. Downside risks to this forecast would be political instability continuing even after the European elections. And on the upside, decisive action by the ECB in June or after the summer would lead us to revise our forecast upwards.
Danae, thank you very much for joining me today. That's all from me for this week, but make sure you click back to Dukascopy TV again next week, as we'll keep you updated with plenty more exclusive interviews. Bye for now.